Hello, good day, everyone. Welcome to today's lecture in a practical introduction to day trading. So in this lecture, we will cover assets to trade. We will start first by looking at a recap at what we covered in the previous lecture, and we will also look at what assets should you trade. So in the previous lecture, we started with assets. We made a distinction between physical assets and financial assets. We said that physical assets are assets that you can touch. For example, there's a house, there's a car. These are assets that you can touch. These are physical assets. Financial assets is another category of assets. These assets include stocks, bonds, currency pairs, derivatives, commodities, and cryptocurrencies. Indices are also a type of assets. These assets tend to be comprised of stocks. So stocks, what are stocks? Stocks represent a share or unit of ownership of a company. So there are many companies, and many companies are listed on financial exchanges. More specifically, these companies are listed on stock exchanges. These companies have gone public, meaning that any individual or any organization can buy a share or buy a percentage of ownership of the company. So what I have here, a stock represents a share of ownership of a company. All stocks have a symbol, which is called a ticker. So for example, BAC, that's the ticker for Bank of America. GE is the ticker for General Electric Company. CHK is the ticker for Cheapstake Energy Corporation. Let me show you an example. So we see here BAC. This is the ticker for Bank of America. Let's look at a different stock. So this stock C, the C is the ticker for Citigroup Industries. Let's look at another stock. WFC. WFC is a ticker for Wells Fargo and Company. Let's look at the price of the stock over a period of time. So we can see here the price. We can see here the stock price of WFC change over a period of time. It went up, it went down. Well, this went somewhat sideways. It went up, it went sideways, slightly went down overall, but it went sideways overall. And then it went back up. This is an example of a stock of a company. So if you want to look for stocks of companies, you can go to this URL here, Yahoo Finance, and you can see companies and their stock. I actually use Yahoo Finance to see companies and their stock price. I look for the most actives. I look for the companies whose stock prices are increasing the most on a daily basis. This will give me an idea of what companies experiencing the most price volatility for their stock. Recall that if you are trading and if you are speculating, you are trying to make a profit from the change in the price of an asset, then you should be interested in the most active stocks. If you're interested in stocks, you should be interested in most active stocks because these stock prices are moving the most. So if it is you seek to make a profit from a change in the price of the stock, then you can consider buying a stock of a company whose price is rapidly moving. So we have here other types of assets. Commodities are also financial assets. So I have here oil, gold, silver. these are all commodities. And as I mentioned previously in a previous lecture, we have different groups of commodities. We have energy commodities, that includes oil and natural gas. We have metals, so that include metals such as tin, iron, steel, and copper. We have agriculture commodities. This includes commodities such as rice, flour, wheat, sugar, etc. Within the metals category, there's a subgroup or a subset called bullion, and that refers to precious metals. That's like gold and silver. A currency pair is another type of asset. A currency pair is an exchange rate. For example, you can have the TTD USD, or you can have the Euro USD. All these are currency pairs. A currency pair is a ratio. It expresses how much units of one country's currency could purchase 1 unit of our next country's currency. So I can give you an example. In Trinidad and Tobago, the exchange rate between Trinidad and Tobago and US dollar is approximately 6.5 to 1, meaning this, that approximately $6.50 Trinidad and Tobago dollars is approximately equal to 1 US dollar. That is the exchange rate. An exchange rate can also be expressed as a quotation. So for people that pursued a degree in economics, if you did year 3 international trade, you may learn that a currency pair is sometimes called a quotation. We can have here a quotation, the Euro USD equal to 1.25. This means that 1 euro dollar, the currency at the front here is referred to as 1, is exchanged for 1.25 US dollars. This means that 1 euro dollar is more than 1 US dollar. When looking at the quotation, remember the currency at the front is interpreted as 1. If the number is greater than 1, so if the quotation number here or the forex number here is greater than 1, that means that the currency at the front is stronger or greater than the currency at the back. So there are 3 categories of currency pairs. One category is referred to as the majors, one category is referred to as the minors, and the third category is referred to as the exotics. So I have here the majors. The Euro GBP, that's the Euro British Pound. The Euro AUD, that's the Euro Australian Dollar. You have the GBP JPY, British Pound Japanese Yen. CHF JPY, Swiss franc Japanese Yen. NZD JPY, New Zealand Dollar Japanese Yen. GBP CAD, that's the British Pound Canadian Dollar. All these are majors. These currency pairs are actively traded on the financial markets. Anytime you want to make a trade, any of the majors, that is to buy or to sell, the broker will allow you to make the trade, provided that you have sufficient capital. That is because there's massive liquidity on the forex market to facilitate the trading of these majors. These majors also have the lowest spreads. So in a future lecture, I will go in detail and explain the bid-ask spread. So the ask price, when you want to buy an asset, you buy an asset at the ask price. When you want to sell the asset, you sell at the bid price. I'll explain that in detail, greater detail in a future lecture. These are the minors. The minors are also popular currency pairs. So we have the Euro GBP, we have the Euro AUD, we have the GBP JPY, that's the British Pound Japanese Yen. We have the CHF JPY, Swiss franc Japanese Yen. We have the New Zealand Dollar Japanese Yen, and we have the British Pound Canadian Dollar. These are minors. Most of the time that you want to trade miners, you will be able to implement a trade. Exotics is the third category of currency pair. These are currency pairs that include the currency of a developing country. For example, we have the Euro TRY, that's the Euro Turkish Lira. We can have the USD HKD, that's the US Hong Kong dollar. We can have the JPY NOK, that's the Japanese yen, Norwegian krone. We can have the New Zealand dollar, Singapore dollar. We can have the British pound, South African rand. We can have the Australian dollar, Mexican peso, and we can have the US dollar, Trinidad and Tobago dollar. These are just the example of some exotics. There are more exotics than these. I do not recommend anyone to trade any exotics. Why? Because sometimes these exotics are closely managed by a central bank. In other words, the central bank allows the price of the currency to go up, or they allow the price of the currency to go down. So if they do not want the currency to move in a certain direction, they will manage their reserves of foreign currency and they will prevent the exchange rate from fluctuating. I don't trade these exotics because if you do, you are at a risk, in the sense that if you want to trade these assets with the objective of making a profit over changes in the price, you might enter a trade, and then when you're expecting the price of the asset to go in your direction, it doesn't move because it is being manipulated by the central bank or whoever is the monetary authority. I do not trade exotics for this reason. Not only that, exotics are also prone to a thing called stock halts. So a stock halt is when you want to buy an asset or you want to sell an asset, but you are unable to implement a trade because the price has now frozen. In other words, there has been some interference in the market by the regulator, by some monetary authority, and the monetary authority is not allowing the price of the asset to change. Exotics are very prone to stock halts, so I do not trade exotics. For me, I consider exotics to be very risky. So quotations can be expressed in two ways. So for example, we can express one quotation as the AUD GBP, or it can be expressed as the GBP AUD. Just remember that when we express it like this, the currency here in front is the currency that we noted as 1. So the next thing I want to mention is appreciation and depreciation. So this might sound far-fetched, but it is not very difficult. Essentially, currencies can fluctuate. Currencies can go up, currencies can go down. Currencies can experience appreciation or currencies can experience depreciation. If a country's currency has experienced an increase in its value relative to another country's currency, then that country's currencies would have experienced an appreciation. This sounds technical, right? Well, it is not that difficult. Let me give you an example. So the exchange rate between the Trinidad and Tobago's dollar and US dollar is approximately 6.5 to 1. So 1 US dollar is equal to approximately 6.5 Trinidad and Tobago's dollar. So this can be expressed in this manner. This suggests US dollar here. The US dollar is noted as 1. This is Trinidad and Tobago dollar in the back. If mere fact that this number is greater than 1, it suggests that the US dollar is a stronger dollar. So the USD TTD can be expressed like this, 6.5. How do we show up an appreciation? If we want to show an appreciation of the US dollar, it can move like this. So if the USD TTD move from 6.5 to $7, it means that the US dollar would have appreciated relative to the Trinidad dollar, meaning that the US dollar has now become stronger relative to the Trinidad and Tobago dollar. But every time one country currencies appreciates, the other country currency also depreciates. So in this example here, the exchange rate between the USD TTD was 6.5. Now, if the exchange rate moved to 7, what that meant is that it now takes more units of Trinidad and Tobago's dollar to buy $1 of US currency. So Trinidad and Tobago dollar is now less valuable than before. It is now more difficult to buy the same amount of US dollars as before. So Trinidad and Tobago dollar has depreciated in value relative to the US dollar. This is how we show a depreciation. When one country appreciates in value against another, the other country will also experience a depreciation in the value of its currency relative to the other country. This might sound technical, this might look very difficult. All I'm trying to tell you is currencies value go up and they go down. Let me show you. So this is the USD CHF, and it was fluctuating. It went up, it went down, it went up, it went down, fluctuating, appreciating and depreciating. So I am moving on. So I have here, when a country currencies depreciate against another country's currency, it takes more unit for the domestic currency to buy the foreign currency. So we have here, for the example, if the GBP AUD moved from 1.8619 to 1.8719, then the GBP would have appreciated against the AUD, and the AUD would have depreciated against the GBP. When a depreciation occurs, it means that a currency now purchases less than before. So it will now take more units of the domestic currency to buy units in the foreign currency. This is why I give you the example of the USD TTD. If the USD TTD moves from 6 to 7, it means that the Trinidad and Tobago dollar would have depreciated against the United States dollar. So we're moving on. So we looked at different assets. We look at stocks, we look at bonds, we look at cryptocurrencies, we look at futures, we look at commodities, we look at forex. So let me ask you an important question. What type of asset should you trade? Now, this is a very important question because many people are interested in the financial market, but they do not know what type of asset to trade. They might consider stocks, they might consider bonds, they might consider cryptocurrencies, they might consider commodities, and they might even hear about forex. But what should they trade? There are so many assets they can trade. What should they trade? Many people graduate from university on a yearly basis. I have the example here. 9,000 people may finish UE. UE is University of the West Indies. I pursued my BSc, MSc, and PhD in economics at the University of the West Indies, St. Augustine campus. So in my hypothetical example, I assume that 9,000 people finish university, and let's say these people are interested in trading the financial market. So how much money can the average person allocate towards trading? Most likely it's not much. Most likely the average person will not be able to allocate an entire $10,000 towards trading. Most likely they would be able to afford approximately $100 to 500 US to open an account to start trading. Some people may have deeper pockets and they may be able to open an account with $2,000 to start trading. However, not everyone has that large amount of money. So it is reasonable to expect that most people will only be able to open an account with about $100 to $500. So if you have only $100, can you trade stocks? That's a very good question, because some stocks are $100. Now, when you go on a stock market and you want to buy and sell stocks, you have to enter trades through a broker. Now, the broker typically charge a commission for every round trip. So if you want to buy the stock, you might charge a commission to buy. And if you want to sell back the stock, they might charge a commission to sell. Different brokers have different prices, but on average, a broker might charge $10 to buy and they might charge $10 to sell. If you only have $100 and you want to buy one share of a stock, in order to buy that stock that costs $100, you need to have $110 because you must be able to pay the broker's commission. If you don't have $110, you can't buy the stock. Now, assuming that you buy the stock at $100 and you sell back the stock at $100, you still have to pay the broker commission. So you have to buy the stock at $100 and sell back the stock at $100. So the only how you can trade that stock is if you have $120. So literally, you cannot trade that stock. You need to have more than $100 if you're trading stocks. In fact, you need to have more than $100 if you're trading stocks. For instance, if the stock price went from $100 to $110, that's a $10 increase in the price of the stock. But assuming that you had only $500 and assuming that you bought only one stock, then when the price of when you buy at $100 and you sell at $100, theoretically you would have made a profit of $10. However, you have to pay the broker $10 to buy the stock and you have to pay the broker $10 to sell back this stock. So you have to pay $20 in commission to the broker. So therefore, you would have made a loss of $10. You made a profit of $10 over the change in the price of the asset. However, because you have to pay $20 in broker fees, that's the fees for the round trip, you end up making a loss of $10. So generally speaking, you need to have a larger capital base if you want to trade stocks. The same concept applies to bonds. You need to have a larger capital base if you want to trade bonds. You need to have a larger capital base if you want to trade cryptocurrencies. However, with forex, you can trade forex with a very small capital base. Forex brokers make money off the spreads. They make money off the bid-ask spread. So forex brokers make money off the bid-ask spread. So you might want to buy a forex. You might want to buy a foreign exchange. You could buy the forex instantly at this price here, 1.0004. However, you can sell, if you want to sell the asset immediately, you can sell the asset here at this price, 1.0002. So there's always a spread. There's always a bid-ask spread. This is the spread here. This is how forex brokers make their money. You buy at the ask price, you sell at the bid price. If you observe here, you will always buy at the higher price and you always sell at a lower price. For a major, the spread is very small. However, with exotics, the spread can be wider. So the last thing I want to mention is a PIP. What is a PIP? A PIP is a percentage in point. So I have this diagram here and it shows a currency pair. So to derive the PIP, we look at this number here. The 8 is 8 pips. This 8 is 8 pips. How we recognize the PIP? The PIP is the 4th decimal place. So we have 1 point, 1 decimal place, 2 decimal place, 3 decimal place. The 4th decimal place is the PIP. So this is 8 pips. The 5th decimal place is a pipette. A pipette is 1/10 of a pip. The 3 here is 30 pips. The 5 here is 500 pips. The 1 here represents 1,000 pips. And the 1 here represents 10,000 pips. Pips are important because pips measure the change in the price of the currency pair. So we are accustomed to dollars and cents. We have $1, we have 10 cents, then we have 1 cent. So we are accustomed to dollars and cents. However, pips go beyond 2 decimal places. We see here the currency pair went beyond 2 decimal places. This is 1 decimal place. This is the next decimal place. This is the 3rd decimal place. This is the 4th decimal place. This is the 5th decimal place. Currency pairs typically go to 4 or to 5 decimal places. If it goes to 5 decimal places, the 5th decimal place is a pipette. If it goes to 4 decimal places, the 4th decimal place is a pip. When we trade in currency pairs, we need to monitor changes in the price of the asset. The per unit change in the price of the asset can be represented or denoted by a pip. When we are trading financial assets on the forex market, we are trying to win pips. So let me give you an example. Let's say we're looking at a currency pair, the price of a currency pair, and the currency pair was this price, 1.1234. Then the price of the currency pair moved to 1.1244. What was the change in the price of the currency pair? Well, this is the answer right here, 10 pips. We are trying to win pips. Observe, with currency pairs, there tend to be very small changes in the price. So the change in price of a currency pair in any one day might be less than 1 cent. If the change in price is less than 1 cent, the change will be in pips. Recall, this is $1, this would be 10 cents, this will be 5 cents. This number here, the 3, will be 30 pips. This number here, the 4th decimal place, will be 8 pips. The pips record the change in the price of the asset. We are trying to win pips. If the price of the asset goes up or goes down by a few pips, if we correctly predict the direction of the market and enter the correct trade, we can win pips. So we place a bet, the bet will be a lot size, and when we place the bet, if the trade ends up moving in our direction, so we end up taking the correct position on the market, we will win pips. And how do we calculate our total winnings? We multiply the change in pips by our lot size. And that will give us an idea about how much profit we would have made per trade. We covered a lot of content in this lecture. I do not want to include more content in this lecture to overwhelm you. So I will end the lecture here. We will cover more content in the next lecture. Thank you.